Western capital markets are heavily institutionalized, driven by algorithms and passive index funds. The Chinese A-share market operates under a different microstructural reality, functioning as a high-liquidity environment for observing behavioral finance theory in practice. This visualization illustrates the asymmetry in the market's participant base. There are over 2.4 billion active accounts, and 99.76% of them belong to individual retail investors. This specific demographic generates more than 90% of the total daily trading volume. The efficient market hypothesis suggests that asset prices reflect all available information because rational arbitrageurs will correct any deviations. But when retail order flow dominates the liquidity pool, noise trading exceeds the capacity of rational actors, interfering with that self-correcting pricing mechanism. This retail base also behaves in highly heterogeneous ways. During severe macroeconomic dips triggered by geopolitical tension, detailed trading data shows retail capital often acts as a contrarian liquidity provider, buying into the drop rather than executing panic sell-offs. A 90% retail skew generates a structural inefficiency governed by predictable human psychological biases rather than random market noise. The architecture for extracting alpha from these biases relies on the mispricing factor framework developed by Robert Stambaugh and Yu Yuan at the Wharton School. Their research isolates what happens when high investor sentiment collides with severe short sale impediments. In the A-share market, acquiring borrowed shares to short single stocks is difficult and carries significant cost. This split-screen visualization compares the theoretical equilibrium of Western markets against the A-share market. Without efficient short selling, rational capital cannot easily force prices back to intrinsic value, allowing overvaluation bubbles to persist far beyond normal limits. Idiosyncratic volatility, or IVOL, measures the specific, non-market-related price fluctuations of an individual stock. In this framework, IVOL acts as a limit to arbitrage. When an overvalued stock has high idiosyncratic volatility, the risk of a sudden, irrational price spike discourages short sellers from entering the trade. Conversely, high IVOL in undervalued stocks can attract aggressive buying because there is no mechanical limitation on taking a long position. In the A-share environment, traditional fundamental value discovery faces significant friction from these limits to arbitrage. Consequently, systematic alpha generation focuses on harvesting the specific mispricing premiums that accumulate on the short side of these restricted bubbles. To operationalize these theories, quantitative algorithms translate cognitive errors into tradable cross-sectional alpha. This table isolates characteristics predicting retail flow. Regression shows a negative correlation to earnings per share at negative 3.13, and positive correlations to turnover at 3.39, and beta at 3.61. Retail capital avoids high absolute earnings, moving into high turnover, high beta assets. A quantitative distillation of this lottery-like speculation and overconfidence is known as the MAX anomaly. The MAX factor isolates stocks that have recently posted extreme single-day returns. This chart illustrates the MAX factor. Retail investors overpay immediately following an extreme one-day price spike, anticipating a breakout. Lacking fundamental support, the asset undergoes a slow mean reversion. The strategy buys low max deciles and shorts high max deciles, capturing this premium. Retail demand for lottery-style returns creates a mathematically predictable pricing error that systematic models can map and exploit. Beyond overconfidence, market microstructure is shaped by the disposition effect. Derived from prospect theory, this is the human tendency to sell winning positions quickly to secure gains while holding losing positions to avoid a loss. The CGO factor calculates unrealized profit against a 100-day cost baseline. A positive CGO triggers premature retail selling, creating overhead resistance. Conversely, a negative CGO indicates trapped capital. Loss aversion prevents selling, creating an order book vacuum that primes a short-term price reversal. The CGO factor succeeds by providing a visualization of order book friction and liquidity vacuums derived from investor psychology. Exploiting behavioral anomalies is a zero-sum game. As more capital targets the same biases, the associated premium undergoes alpha decay. Post-earnings announcement drift, or PEAD, describes the tendency for a stock's price to continue moving in the direction of an earnings surprise. To capture this, models historically relied on the absolute opening gap, measuring the difference between a stock's opening return and the broader market index. This chart tracks the traditional AOG factor's excess returns. After years of steady climbing, the curve flatlines, with volatile drawdowns beginning in late 2021. This decay occurred as institutions began front-running retail expectations, turning the earnings gap into a distribution trap to unload shares. Surviving this decay requires higher-order re-engineering. The first step involves replacing the absolute gap with AOG_rank, a cross-sectional ranking that strips out macro index noise to isolate the asset's relative strength. Next is DEMAX, a filter calculating the absolute maximum jump a stock experienced over the prior 20 trading days. If an earnings gap fails to break its own 20-day DEMAX threshold, the model assumes institutional front-running has exhausted the alpha, rejecting the trade. As the A-share market evolves, simple behavioral signals lose efficacy. Survival requires orthogonalizing traditional signals against historical volatility boundaries to filter out institutional crowding. Moving from daily cross-sectional factors down to the microsecond level, Level 2 tick data provides the environment for separating institutional signals from retail noise. VWAP represents a security's average execution price throughout the day. This graph breaks down the Q indicator, comparing total daily VWAP against a secondary VWAP isolating aggressive buying. When Q exceeds 1, institutions possess unpriced fundamental data, absorbing high slippage to accumulate shares quickly. Tick data also exposes deceptive market microstructure, allowing algorithms to identify spoofing and false liquidity artificially placed in the order book. By identifying buy small, sell large order imbalances, the model identifies institutions who are masking their distribution phases as retail accumulation, preventing the fund from buying into a manufactured top. Level 2 tick data allows quant factories to differentiate predatory institutional strategy from the chaotic surface of retail order flow. Processing these behavioral anomalies across thousands of assets simultaneously requires immense computational power, transforming individual psychological errors into an industrialized quantitative factory. The Chinese A-share market is predictably behavioral, driven by a retail base that consistently repeats specific cognitive errors. Modern quantitative models systematically arbitrage these psychological patterns through high-frequency microstructural filters and the Stam-Baum mispricing architecture.